Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Welcome to the show, where we interview the nation's leading real estate entrepreneurs. It's your host, Stephen Schmidt, and I got the lending ninja in the house today. I got Keith Lorigan in the studio, and we're going to be talking about lending for real estate investors. We're going to cover some DSCR, maybe some ideas if you're some young folks and are looking at getting into investing and getting that started off, playing in the real estate market. We're going to have a great conversation today. Keith reigns out of Jupiter, Florida, which is one of the best places in the world to go golf in. It's frequented on the list of PGA players staying out there. I'm a big fan of golf myself, and who knows, maybe we'll talk about our hunting career, and by hunting, I mean those white balls in the trees. So, but before we get started, just remember at Investor Fuel, we help real estate investors, service providers, and real estate entrepreneurs 2 to 5x their businesses so they can build the businesses they've always wanted in order to live the lives they've always dreamed of. That being said, Keith, welcome to the show today.
Hey, thanks a lot, Stephen. Pleasure to be here.
Likewise having you. So give us a little bit of background on you, Keith. What got you into the mortgage biz? How'd you get into it? What got you started? And what are you working on now that you're excited about?
Yeah, I've been in the business 12 years, and I just started my own brokerage about a year or so ago. It's called Harbor Residential Mortgage in Jupiter, Florida, as you mentioned. And I like the fact that mortgages encompasses real estate. I like construction. I like sales. I like finance. So it's kind of a perfect blend for me. And so it's been a nice run. And recently we've added commercial loan brokering to the business. So we kind of encompass all of it. I do want to say that on the residential loans lending side, we're strictly licensed in Florida only, and on the commercial side, we're nationwide. We can do loans anywhere in the country. The commercial side is a little bit more of the wild, wild west in terms of the compliance and the licensing, oddly, but that's just how it is. So we're doing a little bit of both right now.
Sure. So I don't mean this obviously offensively, and I'm sure you won't take it that way, but you're not a 25-year-old spring chicken starting off in a career that you got into when you were 18. What was your background in before you got into the mortgage side? I know you even mentioned on our pre-show, you're like, man, I wish I found this when I was in my 20s or earlier in life. What made you get out of whatever you were doing?
Yeah, well, I mean, I'm 59 now, and I feel good, look good, doing good. But
you do.
I've done a lot of different things, all of them kind of entrepreneurial and sales. I grew up in New England, and then when I was 20, I moved to Southern California, and I finished college out there, and Cal State Fullerton, and then I did a variety of things. Like I said, I was in the auto show business, working for a company to produce new car shows in Southern California. And then I was in the battery business. I was a wholesale distributor, or worked for one there. And then I moved to Florida in '97 to start my own wholesale battery distribution company that sold to new car dealers, and they sold our product through the service departments.
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
And then that manufacturer went out of business, so I was looking for different things to do, and bumped around a little bit, but I landed in the lending and the mortgage world in end of 2012, and I got licensed in January of 13. And so I just asked the branch manager, how do I make money in this business? And he pointed me to two places. He says, if you can be an in-house lender at a real estate company, do it. And if you can be a preferred lender at a builder. And I was able to do that within 90 days without ever having closed a loan. I was in-house lender at a boutique real estate firm here in Jupiter. And then I was super relentless and basically stalking D.R. Horton in my region here. And I was able to become one of those preferred lenders. Now, there was 5 other preferred lenders, so we're all fighting for the deals. But I would go and camp out on a Saturday when, a lot of people came to the sales centers, and with my laptop, and just sat there and did a fair amount of deals. And the reason we were able to do that at D.R. Horton specifically is because at the time, D.R. Horton's mortgage division, I think it's called DHI Mortgage, they were not performing. Let's just put it that way. And the sales reps at the D.R. Horton sales centers had no faith. People were getting calls the same day of their closing and saying, "Oh, we're not closing today," and they got the moving truck outside, like horror stories. People thought they were closing, and it's not. So we had for a minute we were able to do a bunch of deals for D.R. Horton customers, and so yeah, that's what I did initially, and I just kept the foot on the accelerator and just kept building more and more relationships with realtors, and that's really the key. We're not really looking like leaning on doing refinances. I know when the refi booms come, a lot of people get in the business and they do a lot of deals. But first of all, I would say to any of the viewers that if you're in a position to refi, really take the time to look at the numbers, because if you have a mortgage currently and the rate's 7% and you can get a refi rate at 6.5%, seemingly that looks good, right? A lower rate, lower payment. But the thing is, all loans, with the exception of one, is front loaded with interest. And what that means is, even though your payment could be fixed, and it could be fixed for the duration, 30 years is the most common term. 90% of all Americans that get mortgages get a 30-year term, but it's front loaded with interest. That means the majority of your payment, especially in the first 5-8 years, is going to interest. So it's a great deal for the banks. It's not a great deal for somebody like you or I, because it's frustrating. You're in your mortgage, you're making your payments on time every month, and one day you'll just happen to look at your mortgage statement, you're 5 years in, and your loan balance really hasn't gone down that much. So I would just caution people about refinancing. Refinancing absolutely can make sense, but sometimes it's not the right thing, even though the rate is lower, because you have closing costs associated with doing a refinance, similar to those of on a purchase, at least in Florida. And so 90 plus, probably 95 plus % of all people that do refis, they have the option to bundle in those closing costs into the new loan. So you're not actually bringing a check to closing. You're not coming out of pocket. You may have to come out of pocket for the cost of an appraisal, but that's worst case. And so now, you've been paying on this loan, so you've been lowering the loan amount a little bit, but then you add this new, all these new closing costs, and how much you're really saving, because now the clock starts over again on that, where you're front loaded with interest. And just be cautious on the refi when the refi boom comes, if it ever does. People think it's going to happen automatically, but there's no guarantees. So we'll see.
Sure.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Let me ask you this, because this is a really interesting topic, and I'm glad you're the one that brought it up, because there's all these other businesses that are now popping up that are saying, like, we'll help you save, thousands on your interest and pay off your mortgage in 5 to 7 years and blah, 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 right? And, I don't actually currently own the home that I'm in, just because I have, like, a deal that you can't find anywhere. And on my current house I live in. And so, but eventually I know that I'm going to move. Like, we're kind of already too big for the place that we live. And so it's on our horizons here in the next probably maybe even a year. And this is something that's been brought up with the 30-year mortgage rates being, or not the rates, but them being front-loaded with that interest to where you go pay on your house for 8 years. And again, it's a great deal for the bank because they get all their money up front, but you're not really making a wave on really any true equity or anything along those lines in the actual home. And so is that on virtually every 30-year note, or how does that actually work, and why does nobody know about it?
It's a great question why people don't know about it. It's on every 30-year mortgage. And by the way,
Really?
I don't
So
want to
every 30-year mortgage.
Yeah, I don't want to
Well,
knock.
yeah, of course.
I'm not knocking, if you look at the history of the mortgage, which was developed, the 30-year mortgage, all these mortgages, prior to the early 1930s, there were no mortgages. I'm sorry, I take that back. There was a mortgage you could get. It's a 5-year term and a balloon loan. So before 1930, most Americans rented. Now fast forward to today, 90 years later, almost 100 years later, the majority of people own homes. I think it's like 65-ish%, give or take. In pre-1930s, it was just the opposite. Now, what happened was President Roosevelt, developed these things that stimulate the economy. The New Deal. He did these things called GSEs, Government Service Enterprises, and what that is, you've heard of Fannie Mae, Freddie Mac, Ginnie Mae. These government organizations would buy the mortgages and securitize them and sell them as mortgage-backed securities on Wall Street. So what it did, it's a paradigm shift in the American economy when this came out, because it allowed people now to buy homes. It allowed expansion out of the cities, so developers could build suburban communities, because now people could qualify to buy a home instead of renting in the city. Now they could buy a house, and the American dream was starting to really happen. This is all because of that decision by the federal government back in the early 30s called GSEs. And so, but in order to make it financially doable for the banks, they had to front load these loans with interest. Now, if you have a mortgage payment of $1,500 and today's the first payment, I should have this, I could pull it up quick, but I would say 1,000 of that or more is going to interest, right? Probably more than 1,000. And so, so yeah, you're some of it's going to principal. You're knocking down some of it. You're also getting the tax advantage that you don't get when you rent. You can write off the interest part of the mortgage payment on your taxes every year. So that can kind of mitigate your tax exposure. So that kind of creates, it shrinks the gap between what somebody might be paying for rent and what they're paying on their house. And so I don't want to, I'm renting. I get a good deal like you're talking about. If I buy a house, it's going to be way up here. Well, you do have the ability to write off the taxes, the interest that you pay on the mortgage. So that kind of closes that gap, if there was going to be one.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club. So,
anyways, for the history buffs out there, I know I'm going off on a tangent, but when developers could now offer these 30-year mortgages and sell homes in these communities outside the city, it also created jobs for what? We're building highways like crazy. Then you have car dealerships going up. Then you have hotels, motels, restaurants. All that stuff is just starting to explode, all because of the mortgage. So, there is a loan product out there called the all-in-one loan, where it's the only mortgage where you pay principal first. That's worth repeating. It's the only loan where you pay principal first. That's a whole nother podcast. We could do a whole master class on that. So, but you don't always have to take a 30-year mortgage. You could go 20. You could go 15 years. It increases your payment, but you pay less interest over time, and you pay off that mortgage quicker. But as I said earlier, 90% of all people that get mortgages go with a 30-year mortgage because it's easier to make the payment, and they may not qualify for a higher payment loan.
So let me ask you this on that note, because everybody has a different strategy in buying a house. Like for me, as an example, I'm an entrepreneur. Haven't had a year-long W-2 in probably 6 years, I want to say now, where I was at one specific job of employment or whatever. So on that note, for me, and I'm sure even people that are W-2 could do this, but for me, I'm always looking for, ways that I can reduce my tax bill, right? So maybe for me, if I'm not so much concerned about the equity in my home and building that, other than the natural rise that it will have over time, just with the economy and the market, the actual market itself versus paying down on it, that might be an attractive option for me. But like, at what point would it, for somebody considering a 15-year, is there any benefit to doing a 15-year instead of just doing a 30-year and then doubling up on the payment? Or what's your opinion on that?
You could do that. I mean, you could get a 30-year mortgage and say, hey, my goal is to pay this off in 15 years or 12 years or 18 years. And you can get the math, the calculations done. You could probably do it yourself almost on ChatGPT, but you could get that calculation done. It'll show you how much to make. And that gives you the flexibility. Maybe there's a month or two where, it's a dry month. You're an entrepreneur.
Maybe tight. Yeah.
You're going through a swing and you're like, oh, you know what? I'm not going to make that. I'm not going to put another $800 or whatever into my mortgage this month, and I'll just keep the cash. So that's the other benefit. Conversely, if you do commit to a 15-year mortgage or a 20-year term mortgage, there's no wiggle room, right? I mean, you're committing to making those payments, and it forces you to figure it out, right? So
sure.
Sometimes people like that. They need to have like that, somebody holding their hand, holding them accountable, and having a mortgage payment, required payment, is definitely an accountability factor like nothing else.
I guess let me reframe that question a little bit. So, like, if somebody gets a 30-year, but they pay it off in 15 years, are they still going to save, even though it's front-loaded with the interest? Are they still going to save on interest paid, or because you're paying all the interest first, is that still, or not all the interest, but the majority of it, is that still factored in over time where eventually the bank gets all the interest and it's just principal they're paying on?
No,
or is there
no.
no difference?
No, there's really not much difference. So they're still going to have a huge benefit in terms of paying less interest because they paid it off that early. Yeah.
Okay. So it's almost a way to, like, to your point, it's a way to get a lower payment, but if your goal is to still pay the house off early, I still kind of go back and forth on what we're going to do, because part of me kind of thinks like Grant Cardone, where I'm like, you should just never own your house. And then the other part of me is like, yeah, but if we had like 50, 60 grand in equity, that would be kind of helpful every now and then to be able to go pull it out in a HELOC or something along those lines for the right real estate deal or whatever.
Yeah. For sure. Yeah, I mean, I did that with my all-in-one loan, and it kind of acts as a HELOC, and I was able to write a check and invest in a company last year. So I'm a proponent mostly of buying a home. I know that there's some arguments about just renting, and I get it. I mean, I think it's really about what you like, what people want.
Right.
If you rent and then you're saving, you don't have maybe you don't have the same overhead as owning something, because when you own a house, I mean, you're responsible. It depends, right? But in most cases, for the roof, water heater, things break, things fail. Maybe you have landscaping. There's a lot of costs, and if you're renting, you don't have to worry about it. And you can take that money, that extra money perhaps, and invest it, whatever, in the stock market or real estate or something,
Right.
So.
Yeah. I think it just comes down to everybody's financial goals. Like I was absolutely anti Roth IRA until the last couple of years, and I have a little bit of an insurance background from earlier in my 20s and whatnot. And so I was just anti-Roth. And then I did the math on it here in the last few years. And I'm like, well, if I was to put in X amount, it would be worth X amount when I'm 65 tax-free. And, as I've come to find, I haven't found that one industry yet other than real estate that I've stuck with on a long-term basis. Kind of spent my 20s trying different things out to figure out what I actually really truly enjoyed. And I look at it now and I'm like, man, worst case scenario though, if we go ahead and just put our money in a Roth, we're going to have, between my wife and I, we're going to have $3 million when we're 65. And even if we lived off the interest, like, it would still be a great income on top of, if we have Social Security, which is almost nothing. And so it's something that can't be taken away theoretically. But I just didn't believe in that whole, I'm going to put my money in for 40 years and then it's actually still going to be there, because of the way our world's gone the last 15 years. But now I'm like, chances are I'm going to live that long. Chances are we're going to be there. And worst case scenario, even if we lost our shirt in every other business, we'll still have this when we get there. So
I think I show this IRA sheet. This is for my kids. They're 23 and 27, right?
100%.
And it's 5 columns, and it's unbelievable.
Yeah.
How beneficial the power of time, compounding interest has. So, for instance, let's say, you have a kid, and at age 8 you invest $500, and age 9, $750, and $1,000, $1,250, $1,500, $1,750. So you've invested $6,700, okay? And then you stop. They say they're 13. You've stopped investing, and they can get, assuming 10% a year, which is probably a big ask, but over 60 years ish, 55 years. That's $6,700 turns into. It's probably waste of time doing this here.
No, I see it though.
That turns into
Yeah.
1.266, 1.2 million on $6,700. Now, that's the power of compounding interest over time. 50 years,
Right.
a little bit more than that probably. And I mean, my God.
Well, even I'll give you an example. I had a 9-year-old when I ran an illustration with a company that's been in business so long they literally paid out claims to the Titanic victims, if that tells you anything.
Oh, wow.
And I ran an illustration with them. It was about a year ago, and I ran it on my 9-year-old at the time. And if we were to even fully fund even like a Roth for him, for example, at the max of $50,000 or $7,000 a year, whatever it was at the time, I don't know what it is now. It's $5,700, $7,000. It's raised and gone down. I'm not 100% sure. So don't quote me on it. Don't look it up. Shred me apart, internet. But I looked at that, and even if we invested the max into it, on the basis of it compounding, he would have, I think it came out to like $7 million by the time he was 65. And it's like, obviously that's like how valuable would that be of, here, buddy, you're 18 years old, figure out a way to continue putting the max you can in per year, and then you've got this to access and live off dividends when you get to that age, So it's just like, these are the things they don't teach you in school, right?
Right. Yeah. No, I mean, look at this chart is $166 a month,
Yeah,
and so it's just like it and there's 5, and it just shows you various times when you start. Like, let's say somebody's right now watching this, they're 26 years old, and they put in $2,000 a year, and then at age 65, now this is assuming 10%. Okay, so it's just
Sure.
math. It's just math. Assuming 10% rate of return, at 65 years old, it's worth $973,000. And over those years, they've invested $80,000, right? $2,000 a year.
Right.
Now, the other question is, if you know that money's sitting there, let's say you're 40, you're like, oh man, my kids are going to college, my wife wants to get into a bigger house, I'd love to get a new truck, I want to take a trip, I want to buy a second home on a lake, blah, blah, blah. You start tapping into that stuff. Having the discipline to not touch it is really, really important. So, it's like, if you look at the Netflix, like, let's talk about real estate. Like, if I kept, and this is my point, my message also, real estate has always performed. And I'm now speaking long term, because I've bought houses and sold the same house for less money than I paid for it 9 years later. Imagine doing that. I did that, right? Because I've been through all the cycles. But if I had kept that property and every other property I've ever bought, I would have an appreciably higher net worth. But the challenge is trying to hold on to a property while you're trying to buy the next one. You so-called move up. Yeah, I need the equity here out of this one, so I got to sell it, and then I can buy this one. But I guess buy property. If you're going to buy it, hold it, because I don't see real estate over the long haul going down in value. I don't. So it's nice to have your own piece of dirt. Steve, I was just saying that buy real estate, hold real estate, whether it's residential or commercial. You gotta probably do your due diligence, but I think that the message is long-term real estate always works, and it's proven. And I'm a living case of it. Had I kept every piece of real estate that I've owned, I'd be in much better shape. But anyways,
that's what the number one thing. I talked to some of the top investors in the country, people that have literally got thousands of deals under their belt in their careers, and the only regret I ever hear a single one of them talk about is they said, I wish I would have held every single property I ever bought. That's the only one I hear. So I'm totally with you on that.
I mean, look at it. It's hard to do in real estate. It's hard to do it in stocks. I mean,
right.
Like not that long ago, I don't know, 13 years ago maybe, I remember Netflix when they were transitioning from, I don't know if you recall when you get the disc in the mail.
Mm-hmm.
and you ship it back or whatever.
Oh yeah.
That they were starting to migrate more and more to the streaming component, and they wanted to split the fee. I think is what happened, and they wanted to increase it. So it's going to be like $7.99 a month, right? It was like $2 more, and it was all this chatter. I remember reading about the Wall Street Journal that, oh my God, is this going to be the end of Netflix? Is this it? Have they done themselves in? Is Blockbuster going to hold the line on this? And if you look at today, like the Netflix stock is $1,100 a share.
Right.
$1,100. I mean, so it's like now, I never bought it, but look at it. Even if you bought like a couple hundred shares back then, what's the likelihood you would still have kept it all this time? It's rare, right? That's the thing. Like we can go crazy and think about, oh man, I wish I should have kept it. I should have kept it, or I should have kept that piece of real estate. It's hard to do. It's just hard. So, but if you can hold it, because it's gonna pay off in the long run.
Yeah,
So,
we call that in the crypto world. You got to hold on for dear life.
yeah.
Oh, I love that. Well, Keith, tell these fine folks where they can connect with you for more, learn about what you're working on, maybe check you out for a commercial loan since you only do stuff in Florida. But if you're in Florida listening, obviously you got to go to your guy now. So where can people connect with you to learn more about what you're working on, what you're all about?
Yeah, I mean, they can go to the website. It's called harborresidentialmortgage.com. Harbor Residential Mortgage. And we're in Jupiter, Florida, Palm Beach County, Florida. I don't know, probably 80 miles north of Miami and 120 south of Orlando. We're on the east coast of Florida. So that's for Florida only. I'm licensed in Florida. And we're a small boutique firm. We've got a processor. I've got one loan officer. And we move quick. We have a lot of happy customers. And then we have harborcommerciallending.com. And that's our sister company that does commercial loans. And we can do those nationwide, actually. So, and those can be a couple $100 million loans. We have the access, the funding sources to do those. So, yeah, check us out. Happy to answer any questions and encourage people to invest in real estate. And there's some great programs. I mean, for instance, on the commercial side, like if you're buying a building and you're going to occupy at least 51% of the space, you could do an SBA loan. It's 10% down and 10% of the closing costs. The other 90% is financed in. So think about that. Like if you own even a franchise, let's say a Subway franchise, and you see a great strip mall, instead of paying rent somewhere else, you could buy that strip mall and occupy at least 51% of the space and rent out the other space. And then maybe one day you want to always be a Subway franchisee. You'll be like, I want to sell the Subway, or I want to put in a different, like a Jimmy John's or something. That's your prerogative, and then you just have this nice rental property. Or think of contractors. Let's say, like a plumber or HVAC guy. They could buy one of those office warehouse, office in the front, warehouse in the back, 10% down with an SBA loan. That's a great program.
You bet.
So, anyways, I like that for a lot of people that haven't maybe thought about it. So, yeah.
100%. We'll go connect with them, show them some love from the Real Estate Pros and Investor Fuel, y'all. And thanks for being here, Keith. We'll see y'all in the next episode.
Thanks for joining us for today's Real Estate Pros show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.